Your bank is systematically extracting wealth from you right now, legally, systematically, and with your full cooperation.
Wait, is that why my savings balance technically goes up, but I feel poorer every single month?
Not a feeling, a function. The 4 largest U.S. banks pulled toward $2 billion in net interest income in 2024. The people funding that number? Earning 0.46% on their savings, while high-yield accounts were sitting at 4.5%, same moment, same rate environment.
How did certain people know to move their money before the rest of us even heard the word high yield? Because I didn't hear it from my bank.
You never will. The system doesn't hide the better option. It engineers enough friction, enough familiarity, enough psychological weight to guarantee most people never act on it.
So this isn't a financial literacy gap. It's industrial-scale behavioral manipulation.
It's architecture, and it runs deeper than most people are prepared to accept. By the end of this, you'll understand how the spread is calculated, how your loyalty is monetized, and why the regulators who watched this happen chose a soft-touch response over enforcement.
That last part sounds like a structural betrayal.
It's not illegal. That's what makes it so effective. But here's what I need you to hold. There is a 5-step protocol, a structured exit framework built from what high net worth clients and rate-sensitive institutional depositors already use. We're calling it the Allocation Protocol. I'm not giving it to you yet.
Why not?
Because if I hand you the answer before you understand the trap, you'll treat it like a life hack. You'll forget it in a week. You need to see the full architecture first.
So the protocol comes last.
It comes after you understand what you're actually up against. And by the time we get there, you'll be ready to deploy it. Let's talk about what this actually costs. Not abstract billions, your life. The average American household holds roughly $8,000 in a traditional savings account. At 0.46% APY, that earns $36 a year. That same $8,000 in a high-yield account at 4.5%, $360. The gap is $393 annually.
That's a car payment. That's 3 months of groceries. That's a utility bill every single month that I'm essentially gifting to my bank's shareholders.
And your bank never told you, not one email, not one notification.
Because they're not incentivized to. I get that now. But walk me through the actual mechanism.
When the Federal Reserve raises rates, banks reprice their loan products within days. Credit card APRs move almost immediately. Mortgage rates follow within weeks. But savings rates, they lag by months, sometimes over a year.
So they profit going up and coming down. Rates rise. They charge me more on my debt instantly. Rates fall. They slash my savings first. How is that even legal?
It's not just legal, it's modeled in advance. The UK's Financial Conduct Authority published findings in 2024 showing major retail banks passed rate hikes to borrowers up to 6 times faster than to savers. 6 times. The regulatory response? A recommendation. Not a fine, not a structural mandate.
A recommendation. The referee spotted the foul and issued a strongly worded letter.
While the game continued, now layer inflation on top. In 2023 and into 2024, U.S. inflation ran between 3% and 4%. If your savings account is earning 0.46%, your real return is negative. You are losing purchasing power every single month while your balance technically climbs.
So my account goes up $3. The cost of everything I buy goes up $30. I'm falling behind while feeling like I'm standing still.
That's the illusion. The number rises, the purchasing power doesn't. And this is where housing enters. The same rate environment that crushed your savings yield drove mortgage rates above 7%. The people who needed to buy homes got hit twice. Higher borrowing costs on one side, negligible savings growth on the other.
Hold on. Someone was on the right side of this trade. Who?
Institutional depositors, corporations, high net worth clients with treasury management relationships. They negotiated rates directly. They had access to money market instruments, T-bills, short duration bonds, tools that automatically repriced with the Fed.
So while I'm earning 0.46%, a corporation parking cash at the same institution is earning what?
In many cases, north of 4%, same building, different relationship tier.
That's not a glitch. That's a 2-tier financial system operating inside the same branch.
The Federal Reserve's own flow of funds data confirms it. during the 22 to 2024 rate cycle. Institutional money market funds grew by over 2 trillion. Retail savings accounts barely moved.
Because the people who understood the system got out. The rest of us stayed.
Sticky deposits, and here's what makes it structurally self-reinforcing. The longer you stay, the more the bank learns about your inertia threshold. Your behavior becomes data. Your delay becomes their model.
They're not just profiting off my money. They're profiting off my predictability.
Multiply that predictability across millions of accounts, and it's worth more than any single high-value client because you don't negotiate, you don't threaten to leave, you just stay.
Until now.
Until you understand what staying actually costs. And we're not done, because the rate gap is only the first layer. The next one is where it gets personal. Here's what the annual reports don't headline. Banks don't passively benefit from your inertia. They actively engineer the conditions that produce it. There's an internal metric used across every major retail banking institution. It never appears in shareholder letters, never surfaces in earnings calls. It's called the deposit beta.
Deposit beta. Plain language.
It measures how much of a Fed rate change a bank passes on to its depositors. A deposit beta of 100% means the Fed raises rates 1%, your savings rate goes up 1%. Full transmission, a deposit beta of 20% means you get 0.20% of every 1% increase.
And what were the actual betas at the major banks during the 2022 to 2023 hiking cycle? The most aggressive in 4 decades.
JP Morgan's retail deposit beta was reported internally at approximately 15 to 20% on standard savings products. Bank of America came in lower on legacy accounts. Wells Fargo's consumer deposit beta averaged below 18%.
The Fed raised rates by over 5 percentage points, and these banks passed on less than 1/5 of that to their regular customers.
While capturing the full upside on lending, credit cards at those same institutions moved from around 16% APR to over 21% in the same window.
That's not a spread, that's a chasm. What you're describing is a quiet tax on everyone who doesn't know the rules.
It is a tax, just not collected by the government. Collected by the institution holding your money, paying you precisely as little as their behavioral model says you'll accept before leaving.
I need a second. Because what you're describing means every person who trusted their bank during the most aggressive rate cycle in modern history was systematically underpaid. By design, with precision, using internal models that calculated the exact minimum they had to offer before customers walked.
That's an accurate summary.
That should be front-page news. Every financial outlet in the country. Why isn't it?
Disclosure laws require banks to tell you your rate. They don't require banks to tell you that rate was produced by a behavioral model specifically engineered to minimize what you receive.
That distinction isn't nuance. That's a calculated omission.
It's the architecture of modern retail banking. And here's where it gets uncomfortable. Some analysts argue this system is necessary, that low-cost, sticky deposits provide the funding stability that enables long-term fixed mortgages, small business loans, community lending at viable rates.
So I'm supposed to accept being underpaid because it subsidizes someone else's mortgage?
That's the cross-subsidization argument. Your inertia funds systemic stability.
That's a beautiful theory that conveniently benefits the institution making it.
Here's the number that ends that argument. During 2023, at peak rate differential, the 6 largest U.S. banks generated a combined excess deposit spread, profit above a fair transmission rate, of an estimated $97 billion in a single year.
$97 billion, extracted from savers who thought they were being responsible.
While those same institutions reported record net interest income to shareholders.
So the record profits weren't just from a strong rate environment. They were built on the gap between what they earned and what they chose not to pay us.
Chose. That word is load-bearing. This was discretionary. Competitors in the same rate environment, online banks, credit unions, fintech platforms, managed deposit betas of 60, 70, sometimes above 80%.
So it was possible to pay more. They just didn't.
because the model said they didn't have to. And here's what should make every person watching this genuinely furious. That those same institutions during congressional testimony in 2004 cited competition and market forces as the primary driver of their deposit pricing.
They cited competition while actively suppressing competitive rates.
In the same breath.
That's not a gray area. That's a coordinated liquidity rug pull on the people who trusted them most.
Not coordinated in a legal sense. Each institution acts independently, but when every major bank models identical behavioral assumptions about their retail base, the outcome is functionally indistinguishable from coordination.
Should this even be public knowledge? Because if enough people understand this, the entire retail banking funding model changes overnight.
That's exactly why the allocation protocol matters, not as a protest, not as a withdrawal run, as a personal structural exit from a system that has priced your passivity into its quarterly earnings.
And you're still holding the protocol.
One more layer, the one that explains why even informed, financially literate people stay trapped. Here's the uncomfortable truth about everything we've just covered. Most people watching this will do nothing, not because they don't understand it, not because they disagree, because the system was specifically engineered to survive awareness.
Stop. What do we actually do tomorrow morning? Because I've been getting increasingly furious, and I need that to become something actionable.
It will, but you need to understand first why intelligent, informed people still don't move, because if you don't understand that barrier, you'll hit it yourself.
Fine. 60 seconds. Why do smart people stay stuck?
3 reasons. First, present bias. The brain systematically undervalues future gains against present friction. Opening a new account feels like effort today. The $300 annual recovery feels abstract. The brain defaults to inaction every time unless the decision is removed from daily psychology entirely.
So it's not laziness, it's neuroscience being exploited.
Second, trust asymmetry. People associate brand scale with safety. JP Morgan feels safer than an online bank they discovered last Tuesday, even when both carry identical FDIC insurance up to $250,000. The emotional weight of a marble lobby beats a 4.5% APY on a spreadsheet.
We're paying for a feeling of safety that doesn't actually cost the bank anything extra to provide.
Third, fragmentation fear. Splitting money across institutions feels like losing control, missing a payment. The mental overhead feels expensive, even when the financial math overwhelmingly favors the move.
And the banks have modeled all 3 of those.
Segment by segment, age group by age group. The people who stay are not financial failures, they're behavioral targets, and the gap between those who understand this system and those who don't is now measurable in lifetime wealth.
How measurable?
A household that correctly repositioned $25,000 in liquid savings across the 2022 to 2025 rate cycle, moving to competitive high-yield products at the right intervals, captured approximately $3,200 in additional interest income over 3 years compared to the base rate equivalent. After tax, still well over $2,000 in pure recovered value.
$2,000 that the other household silently handed to their bank's shareholders. No transaction, no statement, no notification. It just never appeared.
That's the most dangerous form of systemic extraction, the loss you never see leaving.
So the people who closed this gap, they didn't do it out of anger after watching a video.
They built a structure that removed the decision from their daily psychology entirely. Willpower is a depleting resource. The system counts on you running out before you act. Structure is permanent.
The solution isn't motivation, it's counter-architecture.
The same word I used to describe the trap, because the only way to defeat a system built on behavioral architecture is to build your own.
And that's the Allocation Protocol.
That's the Allocation Protocol.
We're finally here.
We're finally here. 5 steps. Each one removes a decision from your daily psychology and replaces it with a permanent structural advantage. Step 1, the liquidity split. Immediately separate your capital into 2 distinct functions, operating cash and 1 month of living expenses. Stays in your traditional bank. It handles payments, direct deposits, automatic bills. Everything else, your emergency fund, short-term savings, opportunity reserve, moves to a high-yield account at an institution with a demonstrated deposit beta above 50%.
How do I find that number? Banks don't advertise deposit beta on their homepage.
You don't need the internal figure, you need the outcome. Compare the institution's current APY against the federal funds rate. If they're passing on less than half, they fail the filter. The federal funds rate currently sits above 4%. Any savings account paying below 2% is failing that benchmark alone.
Simple ratio. No jargon required.
Step 2, the calendar audit. Every 6 months, on a fixed date you schedule today, you spend 15 minutes comparing your current APY against the top 5 nationally available rates, not your bank's promotional materials, independent aggregators. That single habit compresses your rate awareness lag from the industry modeled 18 to 24 months down to 6. You become unprofitable to ignore.
I shrink the window they count on. I stop being a sticky deposit.
Step 3, the reversion trap check. Every time you open a new high-yield account, you document the promotional rate, the reversion date, and the base rate it falls to afterward. Calendar alert 30 days before expiration. When the rate reverts, you renegotiate or you move. You treat it like a subscription you review, not a relationship you maintain.
Banks as utilities, not partners.
Step 4, threshold mapping. Most institutions tier their rates by balance bands. Understand where your capital sits relative to those thresholds. Excess cash. Sitting just above a low-yield tier boundary is being silently taxed. Restructure across accounts if necessary to maximize yield at every band.
And step 5?
Tax location awareness. High-yield savings interest is taxable as ordinary income. For higher earners, moving a portion of liquid reserves into short-duration treasury instruments, T-bills, produces equivalent or superior yields with state tax exemption. The after-tax return frequently exceeds a comparable high-yield savings rate depending on your bracket and state.
So the protocol isn't rate chasing. It's total after-tax optimized yield on every dollar of liquid capital.
That is the exit, not one move, a system.
Now the warning. You always have one.
The Fed's rate trajectory in 2026 is signaling cuts, potentially significant ones. The window where high-yield savings accounts offer 4% plus is narrowing. Every month of inaction now costs more than it did a year ago. The institutions are already preparing for rate compression. Their margins will be protected. If you haven't repositioned, the floor drops faster than you'll notice.
The deadline isn't abstract. The environment that made this protocol most valuable is actively closing.
Act inside this rate cycle, or explain to yourself in 3 years why you didn't.
Everything we've covered, the $142 billion in net interest income, the 15% deposit beta, the $97 billion excess spread, the behavioral models built around your predictability, it points to one conclusion. The savings account sitting in your traditional bank right now is not a neutral financial decision. It is a choice. And if you're making it without understanding the architecture behind it, you're making it for them, not for you.
The system is counting on you scrolling past this.
Prove it wrong.